welcome back to my channel. This is your teacher, Miss Elliot. Thank you so much for subscribing to my channel, and to all the first time viewers, I want to say welcome, and please remember to like, share, subscribe, and leave a comment down below. Once again, welcome to Principles of Accounting class. Our focus in this lesson is preparing the income statement, traditionally known as the trading and profit and loss account. Okay guys, the income statement is divided into two sections, the trading section and the profit and loss section. The purpose of the income statement is to show clearly the profit or loss that has been made by the business over a period of time. Thus, it enables owners or managers to be able to see how profitable the business is being run. One of the most important use of the income statement is that of comparing results obtained with the result expected. It is a very important financial document and is usually prepared at the end of the financial year. Well, most of us, if not all, have been involved in some form of business before. For example, where students attending schools were involved in the selling of sweets. Now, how do you determine if you are making a profit or a loss? So, I'm using the selling of sweets for example, whereas most persons would calculate profit by deducting the cost of the product, which is the bag of sweet, from the total sales to determine their profit. Example, a bag of sweet costs $500, which contains 150 sweets. Each sweets in the bag was sold for $5, which gives us a total of $750. Therefore, one would say that they make a profit of $250. However, this is not a true calculation of the actual profit that was made. This is because in order for you to calculate your true profit, you must deduct the costs associated with obtaining the product. This is called the gross profit. From your gross profit, you will deduct your expenses to arrive at your net profit, which is the amount of money left over after all expenses have been deducted. Let's get right into it, guys. So to calculate gross profit, we will use a simple formula. GP is equal to sales minus cost of goods sold. Oftentimes we do not know the cost of goods sold. So I'm going to share with you 5 simple questions that you will ask yourself and use them to find the cost of goods sold. First question: did you start with any stock? This is referring to opening stock. Another term that we use for opening stock is inventory, and the most recent terms that have been used. 2. Did you purchase any additional inventory? Here we are referring to purchases. If you have, then you will add your purchases. Question 3, did you return any of the items bought? Directly, we are speaking to returns outwards. And remember, return outwards is where the business returned the goods to the suppliers. Therefore, it will reduce the purchase. By reducing, we will subtract return outwards from purchasing. Question 4. Did you pay to carry the items into the business? Here, we are referring to carriage inwards, which is the cost the business bears to carry goods into the business. As such, you will add your carriage inwards. Final question, question 5. Do you have any stock remaining in the business? Now, the stock at the end of the business is known as, or the end of the period, is known as the closing stock. Now, always remember to use these 5 questions when you are calculating or when you are trying to find the cost of goods sold. So now we're going to calculate the gross profit. The formula states that gross profit is equal to sales minus cost of goods sold. So remember, oftentimes we do not know the cost of goods sold, but we are going to use our 5 easy, simple questions that we discussed previously to find the cost of goods sold. But before we get to the cost of goods sold, we have to find out the total sales, because from the sales, that is what we're going to subtract our cost of goods sold. So based on our little activity here, we state that sales is 18,000, but when we look at the other items, we realize that there is return inwards and return outwards. We would have discussed return ins and return outs in our previous lessons. So let's recap a little. Remember now that return inwards is where the customer returned the goods to the business. So when the customer returned the goods, that means that this will reduce sales. So once there's returns in the business, we have to subtract it from sales. So let's go ahead, because in this scenario we have return inwards. So we're going to use up the second column here to put in our information, because we have to do some amount of calculation. So here we have 18,000 and we have a return inwards, and we say that the return inwards reduces sales, so we are going to less returns inwards of $2,000. So when we minus 2,000 from 18,000, we are left with 16,000. This 16,000 is known as the net sales, total sales. Let me correct this. Oops. Net sales, total sales. Now, if you do not have any return inwards, then you will go quite ahead and move to the third column here and put in the total for sales. But once there's return inwards, you have to subtract it, because this would reduce the amount of sales in the business. All right, so now that we know the total sales, remember that we want to find, yes, you are correct, we want to find gross profit. So we have our net sales now. So the next thing we want to find is the cost of goods sold, because in order for us to get gross profit, we have to subtract cost of goods sold from our sales. So let's move right ahead. So we're going to have a heading, less cost of goods sold. Very good. So this is our heading right here. So we're moving along to the first question. Remember our questions, we ask ourselves 5 simple questions in order to find the cost of goods sold. Now our first question is, did we start with any stock? Another term for stock is inventory. Did we start with any? Starting here would refer to opening stock, and remember your opening stock is at the beginning of the period. So if you check back here in our scenario, you realize that we have 2 stock. We have stock at January 1st 2019, and we have stock at December 31st 2019. So your opening stock would be the stock at the start of the period. And remember, another term for stock, or the more newly term use, is inventory. All right, so we'll start with it. So we're going to add opening inventory. So remember now, another term for stock is inventory. So you're going to add opening inventory. So the opening stock would be the stock at January 1st. So we're using up the second column here. So we're going to put in that amount of 5,000. We're doing it a nice little table to make sure our work is neat. In accounting, you need to show neatness. You ensure that your work is neat and clear. All right, so we put in the opening stock. Second question we ask ourselves, did we buy any additional stock? If you had bought any additional stock, then clearly you are referring to purchases. All right, so you would add purchases. Now, remember we talked about return inwards previously, that says that this would reduce sales. Now return outwards reduces purchases. If you have return inwards like we do here, we'd use up the first column because we have to take into consideration our calculation. So we're going to add, purchases. We're going to use up the first column here because we have some amount of calculation to do, because return outwards is where the business return the goods to the supplier. Once you return the goods to the supplier, this will decrease the purchases, it reduces purchases, so we have to subtract it. So the purchases was $2,000 and you return some, so less returns outwards of $500. So we're going to put in that $500. Clear? So $2,000 take away 500 would leave us with $1,500. All right. When you take away when you take away the return outwards from the purchases, what you are left with is known as the net purchases. Very good. So now that we have our net purchases, the next question that we want to ask ourselves is, did we pay to carry the goods into the business? Now, when you carry goods into your business, there's a cost that the business bear, which we refer to as carriage inwards. Once there's carriage inwards, you add your carriage inwards. So in our little scenario here, we have carriage inwards of 250. So we are going to add carriage inwards 250. Very good. So far we have covered 4 questions. So let's quickly review them. First question, did we start with any stock, opening inventory? Did we buy any additional purchases? We would add our purchases. Did we return any of the items bought? Return outwards, you less. Then our fourth one, did we pay to carry the goods into the business? Carriage inwards, you will add. So far we have covered 4 of our questions. Now we need to total. A lot of mistakes that person make is that they tend to add the net purchases or purchases figure and the carriage inwards and totally forget about the opening stock or inventory. Now, when you're doing your calculation, you need to add opening inventory, net purchases, and carriage inwards. So we're going to add up the 3 figures. So here we have 5,000 plus 1,500 plus 250, and that is going to give us a total of 6,750. All right, this 6,750 is known as your cost of goods available. Cost of goods available for sale. So this is what you have available for sales. Cost of goods available for sale. So now we are down to our final question, and that question is, do you have any stock or inventory? If you realize I'm using both terms, do you have any stock or inventory leave in the business? Once you have stock at the end of the period, you subtract that stock is known as the closing stock. So here we're going to less closing stock. Can you tell me the total for closing stock? Sorry about that. Less closing stock, what's the total? Right, if you made mention of $1,000, then you are correct. So we're going to less closing stock of 1,000. Now, when we subtract 1,000 from 6,750, we are going to be left with 5,000. Very good. 5,750. This 5,750 is known as your cost of goods sold. Now that you know your cost of goods sold and you have your total sales, you can go ahead and subtract to get your gross profit. So now when you minus 5,750 from 16,000, you are left with 10,250. Very good. Very good so far. So here we have found the gross profit. Right? So to find gross profit, looking back at the formula, it is sales minus cost of goods sold. Once you get your total sales, you go ahead to find your cost of goods sold. To find your cost of goods sold, guys, all you need to ask yourself is 5 simple questions. First one, did I start with any stock? Did I purchase any additional? That's number 2. Question number 2. 3, did I return any of the items bought? Question number 3. 4, did I pay to carry the items into the business? That's carriage inwards, you will add. And finally, do I have any stock leaving the business? Once you have stock, it is referred to as a closing stock. You subtract from your cost of goods available for sales, and that will give you your cost of goods sold. Once you get your cost of goods sold, then you can clearly state your gross profit, because then you will minus your cost of goods sold from your sales and you will get your gross profit. All right, so we're going to go right ahead now and just put in some lines. So we subtract here just to make some pointers. Right, so we subtract 2,000 from 18 and we arrived at 16. Then we subtract, just put in some lines so you can clearly see. So here we subtract 500 from 2,000 and we end up with 15, which is our net purchases. We add all 3 figures coming down: the opening inventory, net purchases, carriage inwards. So we add all 3 and we arrive at the cost of goods sold, which is 6,750. From the cost of goods sold, we take out our closing inventory and we arrive with, from the cost of goods available, sorry about that, we take out our closing inventory and we arrive at the cost of goods sold. Then we take the cost of goods sold from the net sales and we get our gross profit. Now, okay everyone, now that you have understand how to calculate gross profit, this means that we have completed the first section of the income statement, the trading section. In this section, you are calculating for gross profit. Now we are moving to the next section, which is the profit and loss section. Here we will be calculating the net profit. Now, to find net profit, you will simply add all the business expenses. So different business varies. So expenses, as you can see here, we have some expenses like motor expense, rent and rates, wages, carriage outwards. Some business have insurance, they have general expenses, they have transportation expense. So each business will vary where their expenses are concerned. So using our same example, just look below the closing inventory or stock, you will see the expenses of this business. So we have carriage outwards, we have motor expenses, we have rent and rates. Now we are going to calculate the net profit. So first, our heading, we're going to less expenses. So we're going to find all the expenses of the business. So our first expenses is carriage outwards. Carriage outwards. Carriage outwards is the cost that the business bear to carry goods to the customer. So here we're going to use up the second column, carriage outwards is 200. Then our next expense is motor expenses. Motor expense 400. Then our next expense is rent and rates. Rent and rates here is 700. And then you have wages. Wages here is 350. So now we want to total the expenses. So we have so far 4 expenses. So we want to total. So we have 200, 4, 7, and 350, which will give us a total of 1650. Total of 1650. So let's underline here to show that we add up all our expenses. So our total expense in this scenario is 1650. So to find net profit, you add your expenses and then you take it away from the gross profit, and that will give you your net profit. So when you take away 1650 from 10,250, you will be left with, very good, correct, 8,600, and that is your net profit. So we underline, you're left with 8,600, which is your net profit. All right, so we have in essence completed the income statement, because we calculate for gross profit and we also calculate for net profit. So the income statement is a combined account where you have the trading section and you have the profit and loss section. In the trading section, you are calculating for gross profit, and in the profit and loss section, you are calculating for net profit. Now, when you typically look at your trial balance, you will see that there are other items like your fixed assets, current assets, your liabilities, capitals, and drawings. Those items will go to the balance sheet. So your fixed asset, your current assets, your capital, liabilities, and drawing will be used to prepare the balance sheet. For your income statement, you are going to take your revenue, your expenses, revenue, and your expenses. The only expense that will not go here is drawings, that will go to the balance sheet. All right.